All right, everyone, how are you? We made it to the end of the week, right? Yes, it's sufficiently depressing out there. So to give you a little bit of energy, here's the good news. We're not going to have class this afternoon, all right? So we're going to get through as much as we can. We might go a little bit past 9:30, but we'll get to a good stopping point, all right? No class this afternoon. So we'll, hopefully we'll get through most of chapter 17. If we don't get through it all, we'll finish it up on Monday. Has anybody taken a look at homework number 1? I'm sorry, homework number 4? Hopefully it's pretty straightforward, right? Hopefully you've been able to find some articles on the data that you've been following, all right? So, one of the things I say is I would like it to be as recently as possible, but I recognize that for some of your data, there may not be anything extremely recent, right? So federal funds rate, you should be able to find something pretty recent, right? But Zimbabwean exchange rate, you might have to go back a little bit further, right? So, but do the best you can in terms of finding something recent. And yeah, if there's questions, you can always send me an email and I can try to help. But remember that's due Monday at noon, okay? And then that's our last homework. So basically we'll be done with the homeworks on Monday, and then we'll take our exam on Wednesday, and that's it, right? We made it through the class. So, okay, so what are we talking about today? Today and Monday, we're gonna talk about exchange rates, right? And international capital flows. So to this point, well, we've, we definitely have talked about international issues, right? We've talked about global finance, but I wouldn't say that we've talked about it in any sort of systematic way. And so that's really kind of what we want to do here in the next couple of days is dive into this a little bit more deeply. But before we can talk about the international financial system, which is really what we're going to talk about on Monday, we need to understand exchange rates, because exchange rates are really the fundamental price in the international financial system. So we have to understand why exchange rates go up, why exchange rates go down, and all that other stuff, right? And so that's really the point here of chapter 7. Chapter 17 and the foreign exchange market. Okay. So the FX market, or the foreign exchange market. What is the foreign exchange market? The foreign exchange market is the largest financial market in the world. To give you some idea, about $1.5 trillion worth of trades are made on the foreign exchange market every day. Some days upwards of $2 trillion. So, that's about the size of the Canadian economy is traded every single day, right? So lots of trades, right? Usually in these markets, the minimum trade is $1 million, which gives you some idea as to the size of the money that's moving around. These are OTC markets, over the counter. Remember, what does over the counter mean? As opposed to an exchange. What's over the counter? Remember, we've talked about this a couple of times. Over the counter just means that there is no physical location. It is just a network of brokers and dealers. Traditionally associated with banks and investment banks. So banks and investment banks are the main components of these markets. But it's banks and investment banks from across the globe, right? From across the globe. And so these are, what can I say, very big, very efficient markets, right? Very big, very efficient markets. And of course, what's determined in this is what we call the nominal exchange rate. which is just the price of one currency in terms of another currency. Okay. So of course, this can create some confusion because nominal exchange rates are basically the inverse of each other, right? So if we talk about, for instance, the dollar exchange rate, which we are going to typically denote here as E, right? Unless told otherwise, when I say the exchange rate, I'm talking about the dollar exchange rate, okay? What is the dollar exchange rate? It is, for instance, the number of yen per dollar, okay? So the dollar exchange rate is the number of yen you get per dollar. So for instance, today, I didn't look this morning, but it's something like 102 yen, right? Something close to that. Actually, it might be a little bit lower than that, but there you go, right? What then is the yen exchange rate? It's just 1 over the dollar exchange rate. It's the number of dollars you get per yen. Or about, in this case, $0.01. So when it comes to confusion in foreign exchange markets, half of the time the confusion is getting confused about which one of these you're talking about, right? Which one of these you're talking about. I think I mentioned the other day, or so earlier in class, that there was a person working in a Japanese bank that cost his bank about $100 million when he confused the dollar exchange rate with the yen exchange rate. And instead of buying, what was it? Like he meant to buy like 1 million yen. He ended up buying $1 million at the wrong price. And yeah, I mean, it was a disaster, right? So these are easy things to screw up, right? You just have to be careful, very clear about which one you're talking about. Yeah.
Is it 1 over E or is it Y?
Well, it's 1 over, right? So the yen exchange rate is the inverse of the dollar exchange rate, which is, so if the dollar exchange rate is yen per dollar, this is the number of dollars per yen, right? In reality, this is a very big market, but I think we can, in general, it's not a bad assumption to assume that this is a perfectly competitive market. Right? Particularly for a currency like the dollar that's traded heavily, we can really just apply simple supply and demand analysis to understanding movements in the dollar. Here you could have the quantity of dollars traded. And here's the exchange rate, the price of the dollar. There's demand for dollars. And probably the only unusual thing about this is that when we think about the supply of dollars, we can really think about the supply of dollars as being vertical, as being fixed. In this case, set by the Fed. Now, is this perfectly true? Does the Fed perfectly control the supply of dollars? No, we've talked about that. But we also know that the Fed has good control over it in the sense that in the long run, yes, it's the Fed that is going to determine the supply of dollars. So as a kind of a first approximation, just assuming that the dollar supply is set by the Fed is probably a pretty reasonable assumption. And so then, what determines the exchange rate? The exchange rate is just determined by supply and demand. Right? It's just determined by supply and demand. in markets, there's really two types of exchange rates. This one that we're going to talk about for the most part is the spot, what's called the spot exchange rate. This is for immediate trade. But at least from major currencies, there's also a second exchange rate that gets traded, and this is the forward exchange rate. Right? And so you can imagine why there's a lot of trade in future or forward exchange rates, right? So right now there's probably trades going on for, let's pick a date, January 1st, right? So enter into a transaction in which on January 1st, somebody will trade, for instance, yen for euros, okay? Why might somebody be doing that on January 1st? Well, there's two reasons. One is maybe you're a manufacturer, right? And maybe you need to conduct an international trade and you would prefer to lock in an exchange rate today so you don't have to worry about the risk, right? So that would be one use of a forward exchange rate. And then of course the other use is sometimes people speculate, right? So you might be speculating. You might want to lock in a euro-yen exchange rate because maybe you think that the yen is going to appreciate in value. And so you want to lock in a lower, what you consider to be a cheaper exchange rate and make sure that you can benefit from that, right? So unless I say otherwise, I just assume that I'm talking about a spot exchange rate. But you should know that in these markets, a lot of trades, in some markets, almost half of trades or more are really forward exchange rates, right? They're really looking forward to trading things at different points in time. Is a strong, given we're talking about the dollar, is a strong dollar a good thing? Is a strong dollar a good thing? Yeah, I have to say, this is one of the things that when I hear people say, yeah, the strong dollar is really good, I really have to think, wow, you don't really think much about economics, do you, right? I mean, is when Apple prices are strong, is that a good thing? No, it's just a thing, right? I mean, a strong dollar meaning when the dollar appreciates, creates costs and benefits. Right? It creates costs and benefits. So it is not unambiguously a good thing, and it's not unambiguously a bad thing. It tends to help exporters. I'm sorry, it tends to help importers. But of course, a strong dollar hurts exports. So, an appreciation of the dollar, yeah, if you're an importer, that's great. If you're an exporter, that's not so great. It helps those who own US assets. But it hurts those who own foreign assets. So as I said, like most things in economics, there's nothing that is universally good or bad. It just is what it is, right? High prices hurt some people and help others. And that's definitely what's true about the exchange rate. For some reason, the exchange rate, it gets tied in though to kind of like our national manhood or our national, how good we feel about the economy and how good we feel about the country. But I really would encourage you not to think about exchange rates like that, right? Because a lower exchange rate can be a good thing for a country, right? It can definitely be a good thing for a country. It's not just one way or another. Okay, now let's talk about what determines exchange rates. Okay, and the answer is a lot of things. Right? There's a lot that goes into exchange rate determination, a lot of factors. And not just that, but remember, exchange rates are really determined by what's happening in multiple countries. So when it comes to influences and exchange rates, there are a lot of factors. And exchange rates are among the most volatile prices. For many countries, it's not unheard of, even for big, strong, important currencies such as the euro. We've seen 20% fluctuations in the price of the euro here over the last decade, right? So there is a lot of volatility in these things, in part because there's a lot that goes into it. So, so this is a long discussion, right? This is a long discussion about what things determine exchange rates. Crucially, though, I'm going to try to break them into a couple of different categories. First off, let's think about exchange rates in the long run, meaning over long periods of time. What are some of the most important factors? And I want to focus on 4 factors. So over long periods of time, there's really 4 things that play a big role in influencing what a country's exchange rate is. Of these, though, the one that is most important is an idea called purchasing power parity. Right, purchasing power parity. Okay. Purchasing power parity, you might remember this from principles. Right? This is a topic, at least I talk about this in principles. Purchasing power parity is really a pretty simple idea. It's just simply the idea that prices of similar goods should be the same across countries. And prices of similar goods should be the same across countries. Why? Because of arbitrage. Heard this word arbitrage? This is a fancy financial term for shopping. Basically, people take advantage of price differences. So next time that you go on Google and you're looking for something cheap, just tell your roommate you're arbitraging, and they'll be very impressed, as opposed to shopping, which is what most people do. But yeah, why should similar goods be the same across countries? Because people will take advantage of price differences, right? And so what this means is that the exchange rate adjusts to make this true. So let's think about an example here. Let's say at the current exchange rate that a wide variety of goods are cheaper in Canada than they are in the United States. So what are people likely to do? Assuming there's no COVID, right? COVID kind of puts the kibosh on shopping a little bit. If things are cheaper in Canada, what are people going to do? They'll import from Canada, right? They'll get a truck, drive up to Canada, buy things. Of course, how do they have to do that? How are they going to buy Canadian goods? First, they're going to have to buy Canadian dollars, right? That will increase the price of Canadian dollars. And what's that going to do over time? Make Canadian goods more expensive. The opposite will happen in the US. If people stop buying US goods, then the dollar will depreciate, and that will make US goods cheaper. And so what's going to happen over time? These things should balance out, right? They should balance out. So I think probably the easiest way, or maybe to understand this at a little bit deeper level, is to think about the fact that it's not the nominal exchange rate that matters. But it's the real exchange rate that matters. And it's the price of goods in terms of another country's goods. So instead of thinking about a nominal exchange rate, which is the price of currency, in reality, people don't really care about the currency, right? They care about the goods, how expensive the goods are. So let me tell you, what is the real exchange rate? You can think about the real exchange rate as just being the nominal exchange rate, but it's adjusted for the relative price level. Between the two countries, right? It's adjusted for the relative price level between the two countries. Okay, so this looks a little confusing, but I have to say, all of us who've traveled, has everybody traveled outside of the country? At least most of us. If you traveled outside of the country, you've calculated a real exchange rate. You just never called it that, right? All of us have had the phenomena of we're shopping and we see, a sweater we like, and we think, how much is that sweater in US dollars, right? And then you do a little conversion. You take the local price, you adjust it by the nominal price, or the nominal exchange rate, and then you compare it to the US price. That's all this is doing. You take the foreign price, you adjust it by the nominal price, and you compare it to the US price. That's what a real exchange rate is, okay? So we do this all the time, right? We never called it a real exchange rate, but we do this all the time. And it is a way of thinking about how expensive goods are in one country relative to another. So just to do kind of a simple numerical example that might help us conceptualize this, let's say that for a basket of US goods, in the US, they cost $100. And then the price in Mexico is 1,400 pesos. And then the exchange rate is 19 pesos per dollar. So what's the real exchange rate? Well, we have the price in the US, right? Divided by the price in Mexico. Times 19 pesos per dollar. So if you think about this, the pesos cancel out, the dollars cancel out. We're just left with 100 times 19 divided by 1,400. 1,900 divided by 1,400, or 1.35. So what does it mean when the real exchange rate's greater than 1? Well, I don't think we want to say that. Actually, I think it's really the opposite, right? I think that the way you want to interpret this, though, is US goods are more expensive than Mexican goods, right? US goods are more expensive. So in reality, the dollar's worth less because a dollar is going to buy you less in the United States than if you converted it into pesos and tried to buy things in Mexico. And then vice versa, what happens if the real exchange rate's less than 1? Right, US goods are cheaper than they are in Mexico. So that's a real exchange rate, and that's what matters, right? Nobody, if they were shopping in Europe, would in abstract say 120 euros. That's a good deal, right? That's not what you do. You think 120 euros. Well, let me convert, because we're Americans, we convert that into dollars, and we think, how much is that in dollars? Okay, is that expensive relative to the U.S. or less expensive relative to the U.S., right? So this is actually, I think, a pretty intuitive. We've never conceptualized it as an equation, but we do this in our heads all the time. Now, what does this have to do with purchasing power parity? What is purchasing power parity again? The price of similar goods should be the same across countries. In other words, what should be true about a real exchange rate in the long run? It should go to 1. Or in other words, the nominal exchange rate is equal to times the price in the US divided by the price in the foreign country should equal 1. Or, to rewrite this, what should your nominal exchange rate be? It should just be the ratio of prices in the foreign country to prices in the US. So, this tells us what the key determinant of the nominal exchange rate is. The key determinant of movements in the nominal exchange rate over time is differences in inflation. What happens if inflation is relatively high in the US? The price level in the US goes up faster than the price level in the foreign country. And then what's going to happen to the nominal exchange rate? The dollar will depreciate. And vice versa, what happens if inflation in the US is low relative to inflation in the foreign country? In that case, the dollar will appreciate. Okay. Of all the things that we talk about here that influence exchange rates, what's the most important? This. All these other factors, yes, play a role. They all play a role. But if you had to talk about one thing that is the biggest factor in exchange rates over time, it's differences in inflation. Countries that have high inflation tend to see their currency depreciate. Countries that have low inflation tend to see their currency appreciate. So for those of you who did exchange rate data, right, one of the things you might have noticed is that there is a trend, right, in some exchange rate data. What's driving that trend? Well, most likely it's differences in inflation. If it is a low inflation country, it's going to tend to appreciate against the dollar. And by low inflation, I mean low relative to the US. So for instance, the Japanese yen has had a long-term appreciation versus the dollar. Why? Inflation in the US has been about 2%. Inflation in Japan has been less than 2%. So the yen tends to appreciate versus the dollar. The exchange rate between the US and the Mexican peso, the dollar tends to appreciate. Why? Because inflation's been 2% in the US, but inflation tends to be higher than 2% in Mexico.
For both of them, the greater sign is the same.
Oh. No, I meant to write it like that. So this is, absolutely one of the biggest things that drives exchange rates in the long run. Now, having said all of this, does purchasing power parity hold perfectly? No. For a couple of reasons. First off, as we're going to see, there's a lot of other things that also affect the exchange rate. All right, there's a lot of other things that also affect the exchange rate, things that we're going to talk about here in a minute. Okay, so, right, we're not saying this is the only thing, though I think it is clearly the most important. But I think it's also clear to note that purchasing power parity is probably going to be a better description between certain types of countries and in certain situations, right? And maybe to understand this, we need to think about, does purchasing power parity hold within the United States? Like, is there purchasing power parity between Mount Vernon and Chicago? Shaking your head no.
Things tend to be more expensive in big cities.
Yeah, particularly what kind of things?
Restaurant, food, gas.
Gas. Okay, so let's talk about gas. Why is gas more expensive in Chicago than it is in Iowa? There is more demand, but there's more supply too, right? One of the biggest determinants is gasoline taxes, right? And that's certainly one of the things that is going to influence the extent to which purchasing power parity holds, is the extent to which there's taxes or tariffs that will drive the differences. What's the one thing? There is clearly one thing that is more expensive in Chicago than it is in Mount Vernon. So one thing you are guaranteed to pay more for in Chicago than in Mount Vernon. Rent, housing, right? And what's the deal with housing? You can't buy a house in Mount Vernon and move it to Chicago, right? There are a lot of goods that are non-movable. And to the extent that non-movables are important in your economy, the less that purchasing power parity is probably going to hold, right? So, you know, I think you're right. Restaurants are more expensive in Chicago. A lot of that is just because of rent, right? A lot of that's just because of, you know, what did we say? The three most important things in real estate are location, 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 right? And that's really another way of saying purchasing power parity doesn't hold when it comes to real estate because of these non-movables, right? And so you have to kind of put this in mind when you think about this. Because as I said, exchange rates differences in inflation are very important. But it doesn't necessarily mean that purchasing power parity is going to hold perfectly, right? So let's just look at a couple of examples of this. Oh, sorry, I don't have this pulled up. Give me a moment here. Shoot, sorry. How can I find this? Okay, let's try this one more time. Can you see this? So this is an exchange rate between the United States and the UK between 1973 and 2017. So here's two countries you'd expect to have a fair amount of purchasing power parity, right? You know, we're close trade partners. We have similar kind of institutions. And so what do we see here over time? The red line is the relative price level, right? So it's basically the ratio of PUS to P foreign, right? This is looking at that relative price level. And then here is the exchange rate. Do they match each other? Well, I mean, in the long run, yeah, right? Notice here that the red line kind of, in general, over the long run, follows the long run trend. But in the short run, and here the short run meaning over 2 or 3 or 4 or 5 years, there can be quite big differences between the two, right? Reflecting once again that there's other things that are going on that we're going to talk about, but also that, you know, you have to kind of think about purchasing power parity as a rough description of the world. It's not perfect. Having said that, you know, I think purchasing power parity in many ways does do a pretty good job for many different things. Here's something from The Economist looking at the price of iPhones across South America. And once again, you kind of see a lot of similarities, but then once again, there's some differences, right? And a lot of these differences really relate to tariffs. That some countries impose bigger tariffs than others. So, for instance, an iPhone in Brazil costs almost $1,100, right? While an iPhone in Venezuela costs about $775. In the U.S., this is about $730, right? So, surprisingly, some countries are quite similar to the U.S., but then other countries have more, more volatility. One of the things that the Economist magazine has done for years is looked at purchasing power parity in terms of Big Macs from McDonald's, right? And actually found that, over long periods of time, Big Macs do have pretty similar prices across countries, right? Not always in the short term, but over long periods of time, a price of a Big Mac in the US is pretty similar to where it is the rest of the world, right? In my own travels, I always kind of pay attention to, not that I drink this stuff, but always pay attention to the can of Coke, right? And once again, it's kind of amazing. You can be in some pretty far out places and a can of Coke costs roughly what it does in the United States, right? And so, yeah, all this is to say that purchasing power parity, you don't want to put too much confidence in it, but I think it is a pretty reasonable description of the world, a pretty reasonable description of the world. And clearly, crucial to understanding long-term interest rates because it tells us exactly why inflation is so important. Okay. So this is the first kind of long-run factor. Let's talk about a couple of other long-run factors. These won't take nearly as much time. Okay. Another factor that tends to play a bigger role in the long run is differences in productivity and growth rates. So here we have the dollar market. And let's think about an example. Let's think about a situation where growth is relatively strong in the US. Okay, how do we think this is going to impact the market for dollars? I think this impacts the market for dollars. Well, the Fed sets supply. So do you think this is likely to increase the demand for dollars or reduce the demand for dollars? Guesses? It increased the demand for dollars, right? If for no other reason than strong growth in the US might make US stocks look more attractive. They might make US bonds look more attractive. And if you want to get into the US financial market, you need to buy dollars. And so this is likely to increase the demand for dollars. and lead the dollar to appreciate. All right, this is likely to lead to an appreciation of the dollar. Preferences play some role, right? For instance, let's say that there's some preference for US exports. Particularly, let's say there's an industry that is particularly appealing, right? Whether it's entertainment or whatever. You can probably guess it's really this same graph, right? This is going to buy US goods, what do you first have to do? Buy US dollars, right? So this is likely to increase the demand for dollars. And then the fourth thing that plays a role in exchange rates is tariffs. Let's talk about this one a little bit, because there's fewer topics that more people are economically illiterate about than tariffs. Okay, so a tariff. Here we're talking about a tax on foreign goods. Okay, so let's think about an example here. All right, this is an example that's happened here recently, where the US has imposed tariffs on Chinese goods. Let's set aside the fact that China has also done this, right? So China's done the same thing on their half, but let's just kind of focus on the US half of this, okay? So what do we think happens here? If the US puts a tariff on Chinese goods, how does that impact the market for dollars? Decrease the market for dollars? So let's think about it this way. If we tax Chinese goods more, then Americans are going to buy less Chinese goods. And what are they going to buy more of? US goods, right? So I think this is likely to increase the demand for dollars. But here's the interesting thing. The dollar appreciates. What happens when the dollar appreciates? US exports get more expensive. So think about this. We impose a tax on Chinese goods with the idea of reducing our trade balance, reducing our trade deficit, sorry. But by doing that, we appreciate the dollar, US goods get more expensive and our exports go down. What's the impact on the trade deficit? Or let's say the trade balance. What's going to be the net impact? Well, the tariffs themselves are probably going to drive up our trade balance. But then the appreciation of the currency is going to do what to our trade balance? Go down. What's the net impact going to be? We don't know. Don't know. You can't tell. And so this is something that economists have been preaching to deaf ears for years. Trump says we are going to reduce our trade deficit with China by imposing a tariff on China. Has that worked? No. In fact, our trade deficit with China now is larger under Trump than it was before. It's not surprising, right? The US was never likely to change the trade deficit one way or another by imposing a tariff. Here's the key. What does get impacted? Yes, it is true that this drives down imports. The tariff drives down imports. But what people don't think about is it also drives down exports. So what's the net effect? Hard to say. Might be a little positive, might be a little negative. Most likely it's not going to be much. And so this is that one of to some people completely unanticipated, or to some people ironic, but to economists just obvious, that the trade war that we've gotten into China hasn't improved the US trade deficit, because it's not going to improve the trade deficit. As we will talk about more on Monday, there are some good reasons why the US has trade deficits. Most of them are because of US policy, right? So we are largely responsible for our own trade deficit, not China, right? And so, you know, this kind of thoughtless trade war, all it's done is reduce the volume of trade, but it hasn't really impacted the deficit between the two. And so, as you can get from my little discussion here, me and most economists are not really big fans of tariffs and trade wars, right? Because they often don't achieve the stated political goals that politicians have when they start them, right? And so this, you know, I've said this about, you know, kind of gotten on the Trump administration's case. But we can think of other examples in Democratic administrations where they started trade wars too. And the same thing can be said about China, right? Because there's been a lot of, you know, you punch me and I'll punch you. So US imposes tariffs on China, and China imposes them back, right? It's the kind of classic slap fight that you'd see between, you know, 8-year-old boys. And it's not good economics, right? I mean, there's the politics, you know, are one thing, but the economics are something else. Okay, so those are the factors that influence exchange rates in the long run, okay? And once again, purchasing power parity and inflation, differences in inflation rates, differences in growth rates and productivity, changes in preferences, and then tariffs, right? Tariffs and other taxes. Now, let's talk about the short run, okay? What kind of things influence exchange rates in the short run? Okay. Well, to understand this, we have to consider a simple fact. If we look at the trade in foreign exchange markets, they're 50 times what the trade in goods and services are. So how do we interpret that? Well, what this tells us is it international trade that drives most movements in exchange rates? No. What is driving a lot of movements in exchange rates? What's driving all of these trades? Goods and services? No, what is it? Yeah, trade, yeah. What's driving all these trades in the foreign exchange markets? Well, what's our class about? Money, banking, finance, right? These are financial trades. And you had a reading about this. I won't spend too much time talking about it, other than to say that cross-border capital flows are huge. And often because of reporting problems, they're much bigger than what actually gets reported, right? There is a lot of money flowing around between countries. And for money to flow from here to there, it also has to change its denomination, right? In other words, we have, when you want to buy a bond in another country, the first part of that is you have to buy currency in another country. And so what this really tells us is that we have to think about financial trades if we're going to understand a lot of movements in exchange rates. Because a lot of movements in exchange rates are not just driven by goods and services. They're not just driven by purchasing power parity. They're driven by financial assets and the returns on financial assets. So how do the returns on financial assets impact exchange rates? And so there's a simple, but I think quite useful way to think about this. And that theory is what we'll call uncovered interest rate parity, which sounds very, very complicated and confusing, but I'm going to try to convince you of it's a pretty simple deal. It's a pretty simple idea. Actually, it's just an application of purchasing power parity, but when it comes to financial assets. Purchasing power parity said the price of similar goods should be the same. What do you think interest rate parity is going to say? The return on similar assets should be the same across countries. This is just assuming, making an argument, that the return on similar assets should be the same across countries because of arbitrage. Because if it's not the case, then financiers will go out looking for cases where returns on similar assets are higher in one country than the other, and they will take advantage of that. Money will flow to where it can get a higher return. So let's think about it this way. Let's say that here's the return on a dollar asset. Okay, here's the interest rate on a dollar asset, such as a T-bill, okay? How should this compare to the return on a similar asset in Japan? Well, let's say that we have a government bond in Japan, that's going to pay an interest rate as well. Is this uncovered interest rate parity? No, because it's forgetting something. if I'm going to buy, if I buy a Japanese bond, is that the only return I get from holding a Japanese bond? What else could impact my return?
The exchange rate.
Changes in the exchange rate, right? Because presumably I'm going to have to buy yen to buy this bond. And then what happens when the bond matures? Presumably I'm going to want to bring those yen back to dollars. So I have to think about the percentage change. I have to think about what the percentage change in the dollar is over the life of this asset. Okay, now, is this positive or negative? If the dollar goes up in value, what does that do to my holding of a Japanese asset? Goes down. So that's got to be negative, right? A positive percent, an appreciation of the dollar will reduce my return to holding a Japanese asset. A depreciation of the dollar, meaning an appreciation of the yen, will increase my return to having a Japanese asset. Okay? This, of course, assumes capital mobility. The idea that capital can move freely between countries. Is capital mobility a good description of the world? Increasingly, yes. Yeah. In fact, this is a very good description of most developed financial markets. What's the degree of capital mobility between the US and Euro financial markets? Almost perfect. I mean, it's almost costless to move money between here and Europe. What about between the US and Japan? Almost costless, right? So between the US and many other developed financial markets, this is a very good assumption. Now, between the US and Iran, no, okay? So we would not expect this to be a good description of the world between the US and Iran, the US and Russia. It's not always a very good description of the world between the US and China, because as we're going to talk about, there are a lot of capital controls in the Chinese financial system that prevents money from moving in and out very easily. So you have to be careful as to where you apply this, right? But where this is applicable, how closely does this equation hold? Almost perfectly, okay? And the reason is, this is exactly what computer trading does, right? I had my old roommate in college, actually was a foreign exchange trader for Paribas Bank. And so I went and visited him one time in Paris. He kind of showed me his outfit. I really kind of questioned exactly what he did, because as far as I could tell, all he did was he had a computer screen, and in it there was some computer program that was basically scanning the globe for this equation, right? Looking for some point where that would hold for a second. And then if this held, what would the computer do? It would borrow in the US and buy a foreign asset and conduct that trade like that, and you just made a profit, right? So you can imagine if you have millions and millions of computers across the globe looking for these kind of trades, yeah, it's going to hold very, very closely. And so unlike purchasing power parity, which you have to kind of think of as a rough approximation of the world, this is a much more exact description of the world where there is capital mobility. Why is this called uncovered? Well, because there is one thing that we don't know in this equation. We don't know what the future exchange rate is going to be. So there is some risk in this. There is some risk. However, in some circumstances, you can get rid of the risk. By getting a forward exchange rate, by locking into a forward exchange rate. This is called covered interest rate parity. Okay, so this is just some finance lingo. Uncovered means you're exposed to risk. Covered means you're protected from risk. How closely do we think this equation holds when there's forward exchange rates available? Absolutely perfectly. Absolutely perfectly. Because one thing we know in finance is there is really no such thing as riskless profit. If there is riskless profit out there, somebody is going to snap it up. And so, yeah, I mean, this holds perfectly. So if you're talking about similar assets, and that's the key, they have to be similar assets, but if you perceive the US Treasury bill to be the same as a Japanese government bill, and you can lock in a forward exchange rate, right, you do it. And so the fact that computers can do this very easily means that the market is going to ensure that this equation holds. Okay, once we understand interest rate parity, then this really kind of tells us a lot about what moves exchange rates in the short run. Okay. Obviously, one of the big things that's going to move exchange rates is changes in the relative exchange rate. And the key here is relative. Because what matters is the US interest rate relative to the foreign country. Okay? So it doesn't matter if both countries see their interest rates go up. What matters is if one changes relative to the other. So what happens if interest rates in the US go up relative to that in Japan? Well, where's money going to flow? To the US, right? This is going to increase the demand for dollars. And the dollar appreciates. So if you read the Wall Street Journal, every day they have a FX market column. Okay, so basically in this column, they kind of talk about what happens in the foreign exchange markets. And the two phrases that are most commonly used in the FX market are inflation and interest rates, right? And so in every day in the foreign exchange market, there's endless discussions about what's happening to US interest rates. And of course, what's happening to US interest rates directly impacts the value of the dollar. When interest rates go up in the US relative to other countries, the dollar tends to be driven up. When interest rates go down in the US relative to other countries, that tends to drive down the dollar, right? That's one of the big factors. Another factor is risk. So here, this is going to be a big theme of what we talk about on Monday. But when it comes to risk, the dollar is just fundamentally different from every other currency in the world. The dollar is by and large seen as a safe haven. In other words, when there's bad economic news, even in the United States, if there's bad economic news, what tends to happen? Investors tend to flock to US assets, particularly T-bills, right? So, you know, the T-bill role as kind of the world's safe haven financial asset typically means that whenever there's risk anywhere in the world, even an increase in risk in the US, we tend to get the dollar to appreciate. So, you know, and we're going to talk about this in 2008, but in 2008, we saw this really weird phenomena of the US went into a financial crisis. And when the crisis started, initially the dollar depreciated as markets got very scared about what's going on in the US financial system. But then as the crisis went on, strangely, the dollar began to appreciate. And I think that was really investors saying, boy, the US financial market looks really risky, but so do a lot of other financial markets. I better just put my money in T-bills. And as capital flowed into the T-bill market, the dollar began to appreciate. So yeah, you know, the dollar is different. The dollar is different. For most other countries, it's like a little bit easier to kind of figure out how risk is going to impact their currency. For the US, you can get these strange situations where risk in the US actually leads to an appreciation of the dollar because capital will still flow into the US, right? Particularly into these treasury bill markets. The last thing here, or the third thing that impacts exchange rates is expected future changes in exchange rates impact the exchange rate. What happens if markets think the dollar appreciates in the future? Well, if you think the dollar is going to go up in value, what do you want to be holding? Dollars, dollar assets. That should increase the value of the dollar. And what does the dollar do today? Goes up, right? This is just consistent with what we've talked about again and again. What drives markets? New information. If markets think the dollar will appreciate in the future, what's it going to do? It will appreciate today. That new information immediately gets priced into the exchange rate. So in that sense, it doesn't really matter whether the information is now or whether the information is from the future. Not really. It immediately gets priced in, right? It immediately gets priced in. So markets are forward-looking like this, right? And this is, this is why, quite honestly, it is so complex to understand exchange rate movements, right? So here we are getting to the end of this chapter. We have talked about 4 things that impact exchange rates in the long run. And we talked about 3 things here that impact exchange rates in the short run. And we have to remember that it's not just for the US that these factors matter, but for every other country that these same factors matter. So if you're following exchange rates, what kind of information do you have to be familiar with? An immense amount, right? And so, trading on these foreign exchange markets is probably one of the most dangerous things you can do, right? John Maynard Keynes, who made millions speculating in the foreign exchange market, almost went bankrupt twice, right? And Keynes was a genius. And so whenever I see these commercials, I don't see them as much as I used to, but they used to be running these commercials that would say things like, you too can make millions speculating on the foreign exchange markets. And, that always gave me a great source of joy, because there's probably no easier way of losing millions than speculating on foreign exchange markets. You'd actually would do much better in a casino, because at least in a casino, you have some idea of what your chances are of winning. In these foreign exchange markets, these are very, very risky propositions, right? And so here it's best left to experts, right? Experts that have the capital of banks and who don't speculate very much, right? Because getting too far out in front of your skis, right, and taking on too much risk in these markets, you can lose big very, very quickly, right? Just to wrap up here, let's talk about a couple of case studies or a couple of examples, just to kind of reinforce these things. Okay, what happened to the dollar during the 2008 crisis? So we just mentioned this a little bit. What happened to the dollar at the beginning? Well, the initial stage was an increase in risk led to a decrease in the demand for dollars, and the dollar depreciated. So initially, the dollar kind of fell. But as I said a minute ago, what happened as the crisis went on? Increasingly, the dollar began to be seen came to be seen as a safe haven. And this was only reemphasized by the Euro debt crisis. So particularly in 2009, when the European debt crisis began to kick in, a lot of people thought, oh gosh, I don't want to be in euros. Well, nowadays, if you don't want to be in euros, where are you going to be? I mean, think about it, right? Where are you going to be? Where else is a safe haven? China? Right, as we're going to talk about, first off, there's a lot of risk in the Chinese financial system, a lot of risk. Most of this risk not well understood even by experts in China, right? There's a lot of hidden risk. Plus, China has pretty extensive capital controls. It's not very easy to put your money in Chinese assets. So China's not on the list. Britain, well, we're going to talk about the Brexit here in a minute. With Brexit, England doesn't look so attractive. South America, gosh, Brazil looks like a mess. Argentina is a continuing mess. Chile is a very small economy, relatively. Africa, right? Once again, not a lot of strong financial systems there. Japan, maybe, but Japanese economic growth has been very weak for years, right? You know, so when you start to do the calculations, right, everything in finance is relative. So while the US financial system at times might look shaky, you have to think about, well, where else would you put your money, right? And I think that's, you know, that's actually a calculation that a lot of people in finance end up with, is that no matter how bad things have gotten in the US, relatively, it still looks pretty good. Another interesting case study is Brexit. We all know what Brexit is, right? This is the Britain leaving the European Union. What do you think has happened to the value of the pound since Brexit? It's tanked. As the demand for pounds has gone down, the value of the pound has absolutely tanked. And this is one of the reasons why Brexit is increasingly looking less and less popular, right? As we've talked about, a depreciation of your currency isn't a universally bad thing. This has been good for British exporters. The problem is, for British exporters, they don't know where they're going to export to. Right? They used to do a lot of their exporting to Europe, continental Europe. Can they do that in the future? Who knows, right? Who knows? Certainly, they don't have a very good idea how it's going to work, because they're still trying to work out systems. If you remember, in Europe, there were basically free flow of goods between England and continental Europe. Now there's going to have to be tariffs and checking, and there's really still not very clear guidelines for what that's going to look like. So in theory, this would help exporters, but in practice, it hasn't. What about those people who've had a lot of assets in European goods? Like, let's say that you're a British person who has all your savings in pounds, but you have a house in Spain, right? Which is a huge proportion of the British population, right? Like, have you ever been to Spain? There's parts of Spain that feel more Britain than Britain, right? So what's happened to them? You have all your assets in pounds, but you hope to one day live your life, if you're not already living in Spain. You're just taking a killing on this, right? Because the value of your pounds relative to the euro has dropped dramatically, right? You've seen big parts of your retirement disappear. None of this should have been surprising. None of this should have been surprising, but yet, you know, a lot of people voted for Brexit without really thinking through the economic consequences, right? Just like there's a lot of people that are kind of, in theory, fans of the trade war, including a lot of people here in Iowa, a lot of farmers in Iowa who, and before the trade war, were big fans of the trade war until the trade war actually happened, and they figured out that the trade war with China hasn't just reduced our imports from China, it's reduced our exports to China. And so, you know, that should have been predictable, but, you know, a lot of people don't think through these things. So, all right. One thing we have not talked about is monetary policy and how monetary policy impacts exchange rates. That's where we're going to pick up on Monday. So on Monday, we're going to talk about monetary policy And then we're going to talk more about kind of the big picture global financial system, right? So that will be where we move on Monday. Remember, homework number 4 is due on Monday. So if you have any questions about that, you can send me emails. Other than that, we're good to go. So, all right, have a good weekend.